Most people believe you need at least $500,000 invested before dividend income does anything meaningful for your life. That belief is the exact reason most people never start. The real number that makes the dividend snowball work is dramatically lower, and it has nothing to do with how much you earn right now. What actually matters is hitting one specific threshold where your reinvested dividends start buying more shares than your weekly contribution. And once you cross it, the math shifts permanently in your favor. In this video, I'll show you the cold hard math behind that threshold, what it looks like in real dollars, and the exact weekly input that gets you there faster than almost any other strategy available to a beginner today. Here is exactly what this video delivers. By the end, you will know the minimum portfolio size that activates the snowball, the specific dollar amount where compounding begins working harder than you are. You will know what weekly contribution gets you there on a beginner's budget. And you will understand the single most important shift in the math that most people investing for years have never actually seen on paper. But here's the number I want you to hold on to until we get there. If you hit the threshold I'm about to describe, and you stay consistent for 30 years, that starting position, which I will reveal shortly, compounds into a portfolio projected to generate over $600 every single month in passive dividend income. Not because you became wealthy, not because you got lucky, because you crossed a specific line in the math and let the engine run. I will not give you that full number yet. Everything between here and there is the story of how it works and why it is real. Stay with me. Before we touch a single dollar amount, I need you to shift how you see this entirely. Because most beginners are asking the wrong question. They ask, how much will the stock price go up? That is the speculator's question. It puts your wealth entirely in the hands of the market's mood on any given Tuesday. The dividend investor's question is different. How much does this asset pay me just to hold it? Not if the price moves. Not if the market cooperates. Just to own it. That reframe is not small. It changes your entire relationship with volatility. When a dividend stock drops in price, the speculator panics. The dividend investor sees cheaper shares that now yield more when they reinvest. Same event, completely opposite emotional response. Because they are playing a different game. Now here is the engine behind all of it, and it is simpler than most people think. Every dividend payment you receive gets automatically used to buy more shares. Those new shares generate their own dividend next quarter. That dividend buys more shares. Those shares generate more dividend. You are not adding money. The machine is feeding itself. That is reinvestment compounding, and it is the only reason the math eventually tips in your favor without you doing anything additional. The technical term is DRIP, Dividend Reinvestment Plan. The plain language version is this: your dividends hire themselves back as workers. And over time, you end up with more workers than you ever personally recruited. That kind of income math, I break it down with real numbers every few days on this channel. Subscribe so you do not miss the next build. Now here is the mistake that wrecks this entire strategy before it even starts. And it is the most common one I see beginners make. They go looking for yield. They type highest dividend stocks into a search bar. They find something paying 9, 10, 12% annually, and they think they have found the cheat code. Free money, passive income on day one. That high yield is almost never free money. It is almost always a warning label. Here is why. A yield is calculated as the annual dividend divided by the stock price. When a company's stock price collapses, because the business is struggling, the yield number inflates automatically. The dividend looks massive because the price cratered, and then, because the business is actually struggling, they cut the dividend entirely. You lose the income, and you are sitting on a stock worth far less than you paid. This is called a yield trap, and it is not rare. It is extremely common in the segment of the market that shows up when you search for the highest yields. The beginner who chases a 12% yield and gets a dividend cut has not found passive income. They have found an expensive lesson. The investor who settles for a 3 or 4% yield on a rock-solid business quietly builds real wealth. Because that dividend shows up every single quarter, grows a little every year, and never stops recruiting more shares on their behalf. Boring wins, boring compounds. boring builds the life you're actually after. So how do you tell the difference between a real dividend and a trap? Here are the actual checks. Not gut feel, not someone's hot take online. Actual financial checkpoints. First, is the yield reasonable? Anything above 7 or 8% deserves intense scrutiny. That does not mean it is automatically bad, but it means you need to ask why it is that high. Second, is the dividend stable or growing? Look at the history. Has this company raised its dividend consistently over 5, 10, 15 years? A company that raises its payout annually is not doing that accidentally. It is a signal that earnings are genuinely growing underneath. Third, is it covered by earnings? Look at the payout ratio. If a company earns $1 per share and pays 90 cents of it out as dividends, there is almost no cushion. One bad quarter and that dividend is in danger. A payout ratio under 60% is generally healthy for most sectors. Fourth, is it covered by cash flow? Earnings can be manipulated by accounting. Cash is harder to fake. Look at free cash flow per share versus the dividend per share. If the cash is there, the dividend is real. Fifth, does the company have a moat? Is this a business that will exist in 20 years? Dividend income over time requires the underlying business to survive and grow. That is not guaranteed. Dividends can always be cut, and even strong companies face disruption. But businesses with durable competitive advantages have far better historical records of maintaining and growing payouts. Run those 5 checks before you buy anything. Let me give you 2 real examples that flip expectations. Example 1. A well-known consumer staples company. Think household products, food brands, things people buy regardless of what the economy is doing, might show a yield of around 3 to 3.5%. To a beginner scanning for income, that looks almost insultingly low. Why bother? But run the checks. Payout ratio under 60%, 50-plus consecutive years of dividend increases, free cash flow that covers the dividend multiple times over, a brand portfolio that has survived recessions, inflation spikes, and global disruptions. That 3% yield, reinvested automatically for 20 years, has historically turned modest starting amounts into something that generates meaningful monthly income. Because the dividend itself grew at 5 or 6% annually the whole time, on top of the compounding share count. The yield on your original investment 2 decades later is no longer 3%. It is closer to 10 or 12% on what you actually paid. That is a completely different number. Example 2. A company showing a yield of 8%. On the surface, exciting. But the payout ratio is over 100%, meaning they are paying out more in dividends than they are actually earning. They have been doing this by borrowing or selling assets. Their free cash flow has been declining for 3 straight years. And they have not raised the dividend in 6 years, which in dividend terms is essentially a quiet signal that they cannot afford to. That 8% yield is not income. It is a countdown timer. When the cut comes, and historically this pattern precedes a cut more often than not, the yield drops, the stock price drops with it, and the investor is left with both less income and less capital than they started with. Same surface appearance, completely opposite outcomes. The difference is the 5-check system. Now let me show you how a beginner actually structures a dividend portfolio to make the snowball work. Think of it in 3 layers. Layer 1, the foundation. This is your boring, bulletproof income base. Dividend ETFs, funds that hold baskets of dividend-paying companies, fit here. The reason you start here is diversification. Instead of betting on one company's dividend surviving, you own 50 or 100 at once. 1. Company cuts its dividend, it barely registers. This layer does not need to be exciting. It needs to be consistent and survivable. Historically diversified dividend ETFs in this category have yielded somewhere between 3 and 4% annually, with gradual dividend growth baked in. Layer 2, the blue chip muscle. Individual companies with long, unbroken histories of dividend growth. Think sectors like consumer staples, utilities, healthcare, and financials. businesses that generate cash in almost every economic environment. These companies tend to yield slightly less than layer 1, but grow their dividends faster, which matters more over 10 and 20-year timelines. You add these because they carry the engine forward even when markets are rough. Layer 3, the growth kickers. A smaller allocation, maybe 10 to 15% of the total, to dividend payers that are growing faster than average. These might yield less today, but their dividend growth rate is high enough that they become disproportionately powerful in the later years of compounding. You keep this layer small because it carries more individual company risk, but it adds fuel when the snowball is already rolling. Together, these three layers create an average blended yield of roughly 3.5 to 4%, with dividend growth of 4 to 5% per year. Those two numbers are the inputs the math needs to do what I am about to show you. Let me give you the number I know you have been waiting for, the minimum threshold that activates the snowball. And I am going to be completely straight with you about what it looks like at first. The threshold is $10,000. That is the portfolio size where, at a 4% yield, your annual dividends cross $400, or roughly $33 a month. Reinvested automatically, that $33 buys you a fraction of additional shares every single month without you lifting a finger. Now, $33 a month is not a life-changing number. It is a streaming service. It is a phone bill. If you came here hoping $10,000 was going to replace your income, I am not going to pretend that is the case. But here is the reframe. And this is the part that matters. At $10,000, your dividends are now contributing to your share count every single month, whether you add new money or not. The snowball has mass. It has started rolling. Every month that passes, the share count is slightly higher than it was. Every quarter, the dividend payment is slightly larger. The acceleration is invisible at first, but it is happening. This is the seed, not the tree. And the gap between seed and tree is what we are about to look at directly. Here is a number that looks bad until you understand it. A blended yield of 3.5 to 4% looks terrible compared to some of the yields you can find online. 8, 10, 12% in certain corners of the market. If you are comparing those numbers side by side, the portfolio I just described looks like it is losing. But that lower yield is not a weakness. It is a filter. It is the direct result of only owning dividends that pass every single safety check. The market average is inflated by high-yield traps, companies paying out unsustainable percentages, REITs under financial stress, businesses in structural decline. Our blended yield is lower on purpose. It reflects only the dividends most likely to still be there, and higher, in year 15 and year 20. The investor chasing 10% yields will likely experience multiple dividend cuts, capital losses, and forced portfolio rebuilds over a 30-year span. The investor accepting 3.5 to 4% with consistent annual growth historically never has to rebuild. They just let the engine run. The slower number is the faster path. Now I am paying off the number I planted at the top. You start with $10,000. You contribute $50 a week. That is $200 a month. A number that is genuinely accessible on a beginner budget without requiring a salary change. Your blended yield is 4%. Your dividend grows at 5% annually. Your portfolio also appreciates modestly over time as the underlying companies grow. Here is the year-by-year progression. Year 1. Your portfolio is worth roughly $12,500. Your monthly dividend income is approximately $42. Unimpressive. The snowball is small and slow. Year 5, you're at roughly $24,000. Monthly dividend income has climbed to around $80. Still modest, but notice, your dividends are now growing faster than your weekly contribution is adding in proportional terms. The tipping point is approaching. Year 10, portfolio value around $46,000. Monthly dividend income approaching $160. This is where the math starts to feel different. Your reinvested dividends are buying meaningful new share counts every single month. Year 15, just over $75,000. Monthly dividend income around $260. You are now generating the equivalent of a weekly grocery run every single month from money that works without you. Year 20, Portfolio approaching $115,000. Monthly income around $400. This is where the snowball's own mass starts doing more work than your weekly $50. Year 25, over $165,000. Monthly dividend income nearing $575. Year 30, $212,000 in portfolio value projected. Monthly dividend income, $636. That is the number I promised you. $636 a month, generated by a portfolio that started at $10,000 and was fed $50 a week by someone who never earned a windfall, never got lucky, and never needed to understand anything more complicated than the 5-check system and the 3-layer structure. That is not theoretical. That is what consistent reinvestment, a safe blended yield, and 30 years of time produces when you cross the activation threshold and let the engine run. And here is what $600 a month actually means in life terms. That is a car payment eliminated. That is a utility bill, a grocery run, and an insurance premium. Gone, replaced by income, your portfolio generates automatically. The goal was never to get rich. The goal was to reduce how much of your life you have to trade for money. And this is where that starts to become real. Now here is the natural next question. What if you already have more than $10,000 to start with? Or what if you want to know exactly when you cross from building to living off it? That is a completely different video, and it might be the most important one on this channel. It is called 3 Milestones That Guarantee You Can Live Off Dividends. And it maps the exact checkpoints between where you are today and the point where your portfolio's income replaces your paycheck permanently. That video is linked on your screen right now. This video was the first step. That one is what comes next. The system only works when you see the whole arc. One question before you go: what is your current starting number? Are you below $10,000, already past it, or just figuring out your first contribution? Drop it in the comments. I read every single one, and it helps me build the next video around where you actually are.